A very warm welcome to all investors present here today. Our Chief Investment Officer, Mr. Sunil Damania, will walk you through the current market landscape. Before I hand it over to you, Mr. Sunil, just two important announcements to make. We are shifting both Model Portfolio and Portfolio Optimizer to Mojo Infinity. We only have last few hours left where you can use this link to extend your plan. This two features which you have will end at the end of your expiry, so you can go ahead and extend this for the long term. It's 14.9 for 1 year, plus we're giving you 2 years free. With that, over to you, Mr. Sunil.
Thanks a lot, Jason, and very warm welcome all of you. Many of you would be really happy today. So what is your exit strategy? This is a topic of this webinar. I'm doing this webinar, this topic first time for the benefit of all the investors. And I'm going to give you some of the tips, or some of the way you can decide your exit strategy, because I can tell you when it comes to stock selection, you may have certain parameters, you may have certain filters to apply. Am I right? But that's only for the buying stock. You never have a strategy when to exit. And Jason, if I don't mind, can we very quickly run a survey and find out how many investors have an exit strategy? They know when they would get out of this company. So do they have that? Till such time Jason is ready with this survey, let me put a small disclaimer. This webinar is purely from an education purpose. Whenever you invest in the equity market, it does carry a little higher amount of risk as compared to any other assets class. And past performance is no indicator of a future returns. So okay, Jason is ready, so let me take a pause and let's be frank. What sahi jawab dena, because many times we decide, we look at our return on equity, look at price to earning ratio, look at so and so forth. Do you have any strategy for exit? And I want everyone to participate in this. As I can see 70% participating, that's a very good sign. I want balance 30% to please participate. Both honestly job dena. And the next half an hour I'm going to make presentation is going to open your eyes. Not only is going to open your eyes, I can tell you, you will emerge as a very, very, very successful investor if you follow what I'm going to talk about it. So please listen to me very carefully. जो कोई आपका मोबाइल फोन है, जो कुछ आप करो, उसको सबको साइड पे रख दो, and please give 100% attention. It is in your interest. I'm suggesting you. Okay, and this is the best investment you can do for next 30 minutes to improve your returns from the equity market. That much guarantee I can tell you. I can see 85% already participate. I don't understand what is happening wrong with the balance 15%. Okay, Jason, what we can do, I think we can conclude this. Okay, 76% they don't have an exit strategy in place. That means 3/4 of the attendees don't have any clear-cut plan when to exit. And when you don't know when to exit and how to exit, I can tell you with confidence, you are going to lose money, or you will not make money that much you are supposed to make. And those who have a exit strategy, at least they have some exit strategy. It's a different story whether the strategy is right or wrong, but at least they understand the importance of having exit strategy. In various forums, whenever I've gone, and I've always said one thing. I want every one of you to be the Arjun of the stock market. And why do I say Arjun? For the very simple reason, Arjun, and because I'm doing two characters from Mahabharata. So there are two characters called Abhimanyu and Arjun. Arjun knew how to enter and how to exit. He had an exit strategy very, very clearly defined, am I right? And he emerged victorious in the battlefield. But unfortunately, Abhimanyu knew how to enter Chakravyuh. He was not aware about how to exit, and he got killed in the battlefield. I do not want any of these investors, those who attend this webinar, to get killed in the equity market. I don't want them to lose equity, their hard-earned money in the equity market. And hence, have entry strategy and at the same time have exit strategy. And if you follow my advice today, which I'm going to suggest you, you will become an Arjun of the equity market. And that's what exactly I want you to do. So please listen to me. Please give me a half an hour. And I can tell you with a lot of confidence, you will definitely praise yourself that, yes, I did a smart thing by spending half an hour listening to Sunil Damania. And that really helped me to become a better investor in the equity market. So, while investors have a buy strategy, they don't have an exit strategy. And normally, it's an ad hoc approach. You know, if you look at in last 24 months, that is last 2 years, you got out of a company and then start putting jot down in a piece of paper and put down an Excel sheet list of the companies you made an exit in last 24 months and the reason for that. And do that exercise, not for my benefit, just for your any benefit. And you would realize it was very ad hoc approach. You had no proper strategy to get out of one particular company or get out of another company. It was completely, and due to that, you have not been able to create or define proper strategy. Today, on 16th September, you are going to take a vow. And that vow is going to be that from today onwards, I am going to shun my ad hoc approach of exit strategy. I'm going to formulate the way you have an entry strategy, the same way you are going to formulate your exit strategy. And then you are going to follow that exit strategy in a very, very disciplined manner. And I must tell you, while a lot of experts do tell you what should be your strategy for while buying a stock, unfortunately, there are not many enough education has been done, including SEBI. Okay, in investor education, they hardly talk about investors when to exit. वो बहुत दिखाते समझाते आपको कि जब कंपनी में लेना है तो क्या क्या फिल्टर रखने चाहिए, क्या क्या चेक पॉइंट्स होने चाहिए. कोई ये नहीं बताता कि कब एग्जिट करना चाहिए. And that's why most of the investors, I don't blame you basically, my dear friend. The problem is that our system has not taken pain to explain retail investors what are the exit strategies that you should have, what are the pointers you should have to make an exit strategy. If you look at any expert will give you buy. Does the same expert come and tell you you should get out of that company? The answer is no. तो आपको पता ही नहीं है कि एंट्री तो ले लिया, एग्जिट कब करने का. And they think that investors are smart enough to define their own exit strategy and they are smart enough to get out of that company. Unfortunately, hota nahi hai. And then you become a very, very long-term investor in a loss-making company. Am I right? I keep saying two things. A same investor is a short-term investor and a same investor is a long-term investor. He is a short-term investor when it comes to booking profit. He is a long-term investor when when the strip goes below the purchase price. And due to that, you don't make money that you should be making in the equity market. Okay, which rightfully you should be making tons of money, but you don't make money because of your poor exit strategy. So now I'm going to give a very pinpointed advice. Please jot it down in a piece of paper. Please jot it down in your mobile. But please jot it down in your laptop, whatever you are listening to this. But please jot it down in a very, like a student. Today you need to become a student. Please jot down. I'm saying this for your benefit, not for my benefit. If you make money, you will be more. You can live your life in much more comfortable manner and much more luxurious manner. I'm going to give you pointers. Okay, and these pointers I'm giving you are easy to follow. It's not very complicated. Easy to follow, and if you follow that, you would be very, very happy investor. So I'm going to give you 16 pointers on a company level when to decide to get out of that company. 3 pointers on a sector level, and 7 pointers on a market level. Okay. So in total, I'm going to give you 26 pointers, which will help you to define your exit strategy. 16, so I'm going from bottom up, 16 from company, 3 on the sector, and 7 on the market level. they are just a pointer that will help you to take investment decision. So 16, 3 and 7. Let me begin with the company, then I'll come to the sector, and then I'll come to the market level. I'll go one by one. And whenever you have any query, any question mark, please jot it down. When we open the floor for question and answer, please put it down at that point of time, and I'll be able to, well, if you need any clarity, if you need more me to clarify, I'll be more than happy to do that. Okay, so let me start with the company level. The pointer number 1. Best time to exit from a company is when everything is going right with the company. Why am I saying so? That means all good things are priced in that company at that point of time. And I wrote one blog in January 2019, and you can go to our blog page, and I've said about HDFC Bank. 2019, January 2019, the private sector bank was the only story in the town, and HDFC Bank can do nothing wrong. And what did I write at that point of time? Because at that time, people used to say, Hira hai sada ke liye, and HDFC Bank mein growth hai sada ke liye. That kind of a heroism. That was when hero worship was done. There are some people used to say that there are two things which are certain in life: death and taxes. Am I right? That's what one very famous investor has said. And third thing, people said growth in HDFC Bank. People took it for granted that HDFC Bank will constantly grow at 20% forever. And that's why I wrote a blog. Is this all good things are priced in this kind of, I would request you please go through and read that blog. It's available on marketsmojo.com/blog, and you will read that my blog of January 2019. Same way, ITC in 2011. Am I right? So that time, if you ask anyone, people would say, boss, ITC can do nothing wrong. वो भगवान था तभी 2011 में. I don't know how many people are there, but definitely HDFC Bank का तो सबको मालूम होगा. January 2019 का, am I right? And look at what happened to the January 2019 till today, HDFC Bank. So best time to exit. I'll give you my own example. Okay, I'm not trying to boast about it, and I'll tell you my failure also. And these are all my learnings. So Reliance Industries, somewhere in last year, same time, or maybe August or September, I'm not able to recollect. Everything was going right. The Reliance was selling stake to Google, to Facebook, and so on and so forth. And at that point of time, the script was going extremely high. And that was the right time to make an exit from Reliance. Why? Because everything was priced it. Am I right? In last 1 year or so, the script has underperformed, Reliance Industries. So when things are, everything is going right now, it's a time to make an exit. And I also tell you what are the strategy you should do, because the reason why investors don't exit, I'll also give you a reason for that and how you can overcome that reason also at the fag end of my presentation. So I'm also going to discuss that. Pointer number 2, when promoters make toll claim about the future performance, and that's a very dangerous sign. In other words, the promoters now is trying to play to the gallery. And before coming for this webinar, I was reading one annual report, and I got the feeling that this company is making a too tall a claim. I don't want to name this company because I've still not completed my reading of the annual report. Okay, so when promoters make toll claim about the future performance, I'll get scary. I'll give you one classical example, which I read about one annual report. Company called Syntax, and something this I was reading this annual report somewhere, and if this all available in the public domain, so you can download that report. And I'm talking about Syntax, maybe of a period of 2011 or 2012. Ab dekh lena uska annual report, and company making a very tall claim at that point of time, and that really, and when I look at it in hindsight today in 2021, it does give me a reason to worry. I can relate to it. To what this company. So when promoters come on TV channel or when someone comes on a give an interview on a magazine or a newspaper, that really makes me a little concerned about the company, because the company is making not a too tall a claim, and if yes, time to get out. Kuch bhi ho jaye. because वो company शायद कर भी लेगा थोड़ा बहुत, but I don't know whether that company will sustain or not. And I'll give you one classical example which happened yesterday when I was listening to Cosmo Films. I don't know how many people listened to that interview yesterday, and that made me worry. I'm giving a live example today. Okay, I was not very comfortable because companies doing diversification into pet care and of course, and making a tool to trolley claims doesn't give me a Jaipuria is the MD of the company. Number three, promoters comes very often now. The promoter previously was little shy. Now he start coming and becoming more and more media friendly. That means it's a sign for worry. In other words, management wants to spend more time in the glorifying the business than want to focus on the business of that company, and it doesn't give me a comfort level. And I would get out of that. That's a pointer number three. Pointer number four: company's performance is too good to be true. In other words, the industry is struggling, but that company basically does extremely well. It's a first sign that management has started playing to the gallery. And this happens more with the mid and small cap, and I can tell you today, when the mid and small caps are doing extremely well, some of the companies are reporting much higher return numbers than what actually they should be reporting it. Okay. I'm not a forensic, I've not done any forensic audit. That has happened in the past, and that is happening as I speak to you. And I will take those numbers with a pinch of salt. I will take those numbers with a pinch of salt for the very simple reason because it's too good to be true. And I'll get out of that company, come what may. Because I believe that these numbers are not sustainable. Either the management is trying to play to the gallery, or there is some speculative element that's basically encouraging promoters to come out with a good set of numbers, but the reality may be a little different. So I will be a little scary. Okay. Pointer number 5. Frequent change in the key personnel or independent director or an auditor. This is it should raise an alarm in your mind. Why? Because this is the classical case of corporate governance. And if that happens, I will never be comfortable. I might as well leave that company. I may basically get out of that company even at the losses. I don't mind. But I will get out of that company, come what may. And remember, this may look, company may go up after you get out, but if you look at this company after 2-3 years, you will realize that how good your decision was or how accurate your decision was that. It doesn't give me a comfort level. The moment I see change in the MD, very frequent, or CFO or the company secretary, I think these are 3 people that makes me worry. Why would the auditor would resign? Why would the independent directors would resign? Why would the CFO would resign? And there is a churn. That's not a very good sign. That's not a very good sign. I can tell you one FMCG company where that happened and did not give me comfort level. Okay, that company is in dairy business, very known FMCG dairy business, did not give me comfort level. I would get out of that company, come what may. Okay, so some the same rule you should be applying when it comes to the exit strategy. Point number 6. When there is a smell on the corporate governance, whether the allegation, it's an allegation or no, proven or not proven, I would exit from that company. I'll give a classical example which happened. I was talking about the company called Financial Technology. And then I was in a previous organization which I was working with. And the company's market cap fell less than what the cash and bank balance was that at that time. You all know National Spot Exchange, which was 100% subsidiary of Financial Technologies. Am I right? And despite the fact that there is this, I said this company cannot do well. And so there was a counter argument by one of the fund manager. It goes, "Usme to paisa itna pada hai balance sheet mein. How can the company can basically market बेवकूफ है क्या? मतलब मुझे मालूम नहीं market बेवकूफ क्या नहीं. I will not be comfortable investing in that company where there is even a smell. Forget about proven or not proven. Something similar happened with 1% beverages. Management coming on TV channel saying everything is hunky dory, no need to worry about so and so forth. And we know what happened. Vakrangi. Nothing got proven against the Vakrangi. There was a smell on the corporate governance. And company continued underperform. Never regained its market cap. Am I right? So Cox and King, Peter Kaiker, okay, one of the finest, the travel company, but you know what happened. So the simple rule, when there is a smell on the corporate governance, please get out of that company, come what may. It doesn't give the comfort level to anyone. Okay, and that happened with one of the leading pharmaceutical company also, and we know how it's underperforming. So probability is very, very high. The market would not like to touch that company when, and especially I'm talking about the institutional investors, when there is a smell on the corporate governance of that company. So that's another pointer number 6. I'm going to give you 16. मैं 6 पे पहुंचा हूं अभी तो. Pointer number 7. Normally when you should exit from a company, when a company which is a very unique business model, and because of that unique business model, the company commands a very rich premium, and suddenly that business is no longer unique. Why? Because there are more and more companies are coming with a similar kind of business tapping the market, and due to that, that unique premium command which company used to command will no longer be there, and hence that company will start underperforming. So I'll give you an example of that. Like for example, PVR, when it came out with an IPO and started trading, was a very different business. Am I right? Because the multiplex, so on and so forth. But if you look at last 5 years, PVR is not giving any meaningful returns. Westlife Development was another classical case, because that's the only company which was basically catering, it's a franchisee for the McDonald's. Am I right? Catering to the QSR, that is a quick service restaurant. So unique business model, and now we have many more companies coming in. That company cannot command the same premium it used to command. And Zomato. So Zomato today is a very unique company. Am I right? It's a play on fintech and so on and so forth. The moment we keep seeing more and more fintech company getting a tap in the market will have a choice to play on the fintech, not only through Zomato, but through other companies in the market. Am I right? When the Paytm comes, and of course we know what Carted, and when we have Nika and so on and so forth, Flipkart is also planning to go public, then you will have more and more play to play on that new age technology play. And that time, the company like Zomato may not command. Of course, I'm talking about the future, but I'm just giving a pointer just to drive home the point. So, past example to the recent example. Pointer number 8. When there is a hike in the remuneration for management is much higher than the common employees, that's the first sign that company is focus is not, the promoter's focus is not there to run the business, because they want to take more money from the company and not taking care of the employees. And when that happens, it's a time to get out. Whoever that is, irrespective of what the quality of that promoter is, whatever the reputation may be, please get out of that company. It doesn't give me a comfort level, because it's not very good sign. It's not very good sign. I can give you examples, but I don't want to give examples today on this. Pointer number 9. Too many related party transactions. Please get out of that. In fact, not only you should get out, in fact, it's also a good checklist for entry also. Okay. And this TV and Z, I think one of the reasons why the script came under pressure, and of course, it went up further because there was an ouster from the management. But there's a few possibly that Mr. Goenka may no longer be the CMD of the company. But in case if that is, forget about Z and DSTV, any company, when there is a too many related party transaction, please get out of that company. Come what may. सोचने का नहीं उसमें, निकल जाने का. Okay. So pointer number 9. But this you should be able to follow. The moment you allow the market noise to decide your emotions, then you will not be able to follow that. Okay. Pointer number 10. Too many group companies in the similar line of business. It's a red signal. I will never invest. So one of the 3 criteria, the moment I know that promoters have a similar kind of business, what happens in that case, there is a very possibility that profitability can be siphoned off. There may not be related party transaction, am I right? But the profit can be siphoned off from one business to another business. Or a company that the group company can thrive at the cost of the public limited company. And I will not be very comfortable. So I'll give you one classical example. One company which recently went public had many businesses, similar kind of business in an unlisted space. That company did not give me comfort level. Normally, those kind of companies will underperform significantly. If you remember, we recommended one stock of the month, Lux Industries. And one of the reasons I picked up that company because that one of the related party business got merged into this company, and that gave me comfort level. There was ये कंपनी में अभी आगे जाके कुछ गफला नहीं हो सकता है. Am I right? Because the business is aligned. The promoters listed business is aligned with the non-listed business. So that's what gives me and comfort level. So pointer number 10. Or if the management announce, today they don't have, but tomorrow they announce a very similar kind of business in the private entity, it makes me worried. It makes me worried. Pointer number 11. Too much dilution of equity capital at the regular interval. And those kind of company can never make money for it. The moment I see a company diluting its equity capital very often, I'm not talking about banks and NBFCs because for them that's a raw material. Because the capital adequacy ratio is to be maintained, am I right? But other than banks and NBFC, that happens, I would be a little concerned. And I give a classical example, Alok Industries. And I always wonder why Alok, if you look at Alok Industries, now it's been taken over by Reliance Industries. But before it went to NCLT, you look at there's a constant increase in the Alok Industries equity capital. And there are many empirical study which has been done. The company that keep diluting its equity capital very often, that company normally underperforms. I would get out of that company. Okay. At the same time, the company they have not diluted its equity capital, invariably they turn out to be profit making, wealth creating companies. So there is a common thing. If you look at the wealth creating company over a period of 10 years and 15 years, there is a one common thing that is there across all companies. They have not diluted their equity capital significantly. Either there is no equity dilution, or if at all there is a dilution, it's much, much less. So pointer number 11. Pointer number 12 is a wrong capital allocation or acquisition of a business which is unrelated. I will get out of that company. Why? Eventually that company will underperform. Eventually that company will underperform because that company, the capital allocation wrong hai. ROE will take a beating. ROE takes a beating. Investors will not like it, and investors will not like it. That company will underperform. And there are many examples where company have done wrong capital allocation or acquired a business which is not related to its core business. They have underperformed significantly. And there is a history available of many stocks like this of that. Okay, it's a matter of study for some of those who are very fond of doing PhD. They should really do it for the benefit of retail investors. Pointer number 13. Acquiring company larger than its own size. That means company is biting more than it can chew. Okay, and if that is so, that company normally underperforms. Get out of that company. Whoever that company may be, whichever group that may be. Even if it comes from a very reputed business house also now, I would be prefer to get out of that because my mall mein wo company nahi karne wala acha. Okay, not only there will be dilution in the equity capital, second thing the integration issue, and fourth thing, does the management have a bandwidth to manage then what the larger size company? And if you look at historically, not in India but globally, the company that has acquired company larger than its own, this one, they've underperformed significantly over a period of. So yes, market may get a little excited initially, but eventually that company will underperform going forward. When the debt of the company rises faster than its profit, that's a pointer number 14. Get out of that. That means today things are looking good. Eventually this company will turn into a loss-making proposition. Why? Because debts are rising. It's not going to sustain that debt going forward. And hence, it's a first signal sign for you to get out of that company. Market may take 3 months and 6 months to figure it out. You should have that insight. And since you look at it, please get out of that company. Pointer number 15. So when 2 consecutive quarters, the profit of that company declines, management justify that for a decline, I would get restless. I'll get out of the company. Why? Because this company will underperform, whether you like it or not. I'll give a classical example, Maruti. Maruti, when there was the flood in Kerala a couple of years back, they suggested that decline the profit because of flood in Kerala. The next quarter, something similar happened. It was a clear-cut sign that company strategy is not in place. And when company is floundering in strategy of this company will underperform. And that's what exactly happened with Maruti. And pointer number 16, especially when the commodity cycle, when the prices touches many years high, that means ये कंपनी पिक पे चलने वाली, उसका प्रॉफिटेबिलिटी भी हो गया है. If tomorrow if the market cycle turns down, this company profits will decline, and if profits will decline, you need to be little wary of it. I'll give you a classical example of graphite, a business that happened somewhere in January 2020. Yeah, I think January 2020 or January 2019. I'm just forgetting the year. And that way, you got an idea कि ये बहुत high पे चल रहा है. It's time to get out of that. And if you had done that, you would have seen what happened to the prices. So this is our pointer number 16. Now coming to the sector level strategy. Okay. There are three. Okay. And these are very fine way you can define that. Pointer number 1. When there is a consensus among the fund manager and the analyst that this sector will do well, please get out. जब 10 में से 10 आके आदमी बोलेगा ना ये सेक्टर बहुत अच्छा लगता है, that means all good things are priced in that particular sector. Please get out. I'll give you a classical example. Private sector bank in 2020, January 2020 or last quarter of 2019. If you were to ask anyone, everyone would have said you need to put money in private sector bank. You should put money in NBFCs. You know the private sector banks are underperforming in 2020 and 2021. All right, and in other words, that's the reason you should make an exit from that particular sector. If you remember in 2012 or so, maybe 2011, 2010 or 2011, pharma was the only story in the town. Right? Each and every analyst and fund will say we are extremely bullish on pharma because of innovation happening. The US market, lot of drugs are going off the pattern, and hence it's a good opportunity for the pharma industry to make money. This is the justification. Am I right? And we know what happened in last 8-9 years, how many pharma companies are able to even create the wealth for the investors. So that's another sign. So the moment you go to TV channel or you read this one, at 10 में से 10 fund manager आके बोलेगा, analyst आएगा बोलेगा, this sector looks extremely good ना, उस company से first thing you should be the first one to make an exit. Pointer number 2. When most of the industry people start announcing capex, what does this normally happen? When this happens, the capex is normally being announced when you are at the peak of the cycle, thinking that both the demand will keep continuing going forward, and hence let me create a capacity to meet the future demand. Everyone thinks that's what's going to happen. And when the capacity gets building up, what's going to happen eventually? There will be excess capacity. Demand may not play out the way it has been emphasized. Am I right? And then problem happens. And that happens, and it can turn into poor financial. So you have to increase your capacity. Your capacity will go on stream when the downside cycle has started. And that's where. So I always like a company which is doing its capex when the cycle is down. Because जब मंदी में कोई पैसा डालता है उस सेक्टर में, that's the best time. Why? Because by the time the capacity goes on stream, because it takes a couple of years, am I right? The cycle would have turned around, and the plant is going on a stream when the capacity is at the best. Okay, and that's where you make a lot of money from that particular company. That's what you should be doing. So that's another thing. Number 3, when many mutual fund manager comes and asks you to invest in the NFO for that particular sector or particular thing. If you remember in 2000, each and every AMC came out with their IT sector. Am I right? Am I right or not? Everyone came out with the IT sector पे पैसा डालने के लिए. Same in 2008, we saw almost each and every AMC came out with the infrastructure fund. Or in somewhere in 2012, 2013, everyone came out with the pharma. And couple of years back, when the mid and small cap were doing well, somewhere in 2016, 17, many people came out with the mid and small cap fund, if you remember. And that's a time you must to realize it is a time to make exit, not a time to make entry. So now we also see a lot of NFOs coming, am I right? If there is a common thing that you are getting it, remember that theme is not going to play out well. That theme is not going to play out well. That's what my advice. So these are 3 pointers on the sector side. Market level exit strategy, market level, bottom up, company, sector, and the market level. Pointer number 1. When market surges too fast in a too short a period of time, when remember what I've observed in the market, that the last leg of the bull run is very swift. Hot market बहुत तेजी में भागता है. Okay, for example, in 2008 really, from August 2017 till January 2018, market went from 13,000 to 21,000 in a very quick space, 54% in 5 months. In other words, if you have to really put it, 10% every month for consistently for 5 years on an average, that's a sign of market में pick out होने वाला है. Get out. Or in 2000, इसके पहले वाली रैली में 60% in 8 months. June 2020 में खाली market 330 पे था, Feb 2006,151 गया. What market? Of course, this rally was given by only IT, tech, telecom, and the media companies. But nonetheless, the Sensex went up by 60% in 8 months. So when you see too quick a surge, it's a sign that market is picking out. Market is picking out. So when the bull run is too swift, in a shorter period of time, get out of that market immediately, which is not the case right now, I must tell you. So you should also look at whether the market has taken a beating or not. In 2008, 2003 to 2000, market was rallying. In 2000, before that, the market was rallying. Now someone may argue, अरे boss, market has rallied from March 2020, but उसके पहले गिरा भी तो था मेरे भाई. So it was high, it came down, and again it's well. Then that logic will not apply. So that logic will not apply. If you look at in last 12 months or so, market is up by only 40-45%. So that means it doesn't give an idea that market is at the last leg of bull run as I speak to you. Okay, so let me clarify that. Pointer number 2, when the rate of interest and the inflation start continuously rising for a year, that means earnings growth will take a decline. Number 1. Number 2, flow of money will move away from equity to the debt. In other words, the 2 things which will not be there, the 2 levers always for the market, earnings growth and the liquidity, and both will face a headwinds going forward. And that's the first sign that you should get out. If I see inflation rising and due to the rate of interest rising, please start making an exit. Pointer number 3, many companies announce big capex and acquisition. एक कभी होता है जब मार्केट में बहुत लंबी बड़ी तेजी होती है ना, when the market is peak, now many people say, like you remember Tata Steel was acquired Chorus at the peak of the boom bull, am I right? Tata Motors acquired JLR at the peak of the boom, am I right? Hindalco acquired Novelis at the peak of the cycle, am I right? And if this kind of a thing happens, it's a sign that market may be mandi aane wala. Let's say market level. Pointer number 4, when magazine like India Today start doing a story on equity market touching all-time high, that means market mein ab bandi aane wali hai. And that's happened with Time also. When you look at Time magazine covered and featured cover story on Nasdaq and Dow Jones when the market was at peak. And whenever they do a story, remember the peak is somewhere very nearby. Okay. Number 5. When mid and small cap companies account for 17% or more of the overall market cap. In other words, and why am I saying so? In other words, the retail investors, they are very fond of mid and small cap, am I right? And they go and they keep buying like a crazy thing that inflate the price of mid and small cap. And if they account for 17% or more, historical data says that they are not able to sustain at that level for a longer period of time, and market will pick. Okay. And the poor quality companies start investors' attention. जो कंपनी लास्ट 15 साल में नहीं चला, 20 साल में नहीं चला, that company start doing well, I think that's clearly a sign. I distinctly recollect, and this I distinctly recollect that one episode. There was one company, I'm talking about this 2007-2008 really. This company was under liquidation, but the scrip was going up every day. It was hitting upwards of I think it was SBI Home Finance, if my memory serves me right or something. And Kirit Somaiya, basically, he was an MP at that point of time from BJP, and he's also an active investor. And he was giving interview to Udyan Mukherjee on CNBC, and he was explaining on what logic this company is going up, because this company is under liquidation. Uska price hone nahi wala hai, and how can this company can go up? And if that kind of scenario happens when the company does not have a business, but is commanding 5%, 10% circuit every day, and that's a sign that market may up mandi aane wali hai. So that's a pointer number 6. And pointer number 7, when retail investors start justifying that market will go up, okay, they argue with you that tu bewkoof hai, aadmi ko malum nahi hai, market to bahut teji hai, and he will explain you that reason. And that's the time. So today when I talk to you people argue with me, am I right? The market mein mandi kyun nahi hogi? And then you will say Jim Rogers has said so and so. That gives me comfort that market mein mandi nahi aane wali hai. The day you started arguing with me and say, "Nahi, aapko malum nahi hai market mein ye fundamental factor hai acha hai, ye factor acha hai." The day you start arguing with me, that means the market mein mandi ki aane ki sambhavana hai. And that's why when retail investors justify the reason for teji in the market, that's the time you are very close to the peak. Now, reasons why you don't have an exit strategy and what basically stops you from selling stocks. Now I'm going to the psychological part of the human behavioral. This is my last leg of my presentation. And then, of course, I've extended my presentation, but we'll make it up. We'll extend our question answer. Don't worry. Whatever query you will have, I'll try to satisfy to the best of my ability. Now, reason why investors fail to in selling stocks. I'll give you this one. There are all human behavioral issues. Due to the market noise that this company will do well. अगर मार्केट में सब आपके बोलेगा ना that basically then you think यार मार्केट में सही होगा मैं इसका गलत होगा, let me not get out of that company. Maybe Suzlon in 2008, DHFL in 2017, 18 or 19, and so on and so forth. Well, market noise doesn't allow you to get out of that company. You believe that this company will do well and you don't want to get out of that. Reason number 1. Reason number 2, the biggest fear. What if I get out of this company and script goes up, then हम लोग को क्या है, हम लोग को दुनिया लूट लेनी है. We always believe that we will always be able to sell at the top of the price. आप भगवान नहीं हो. No investor in the world has been able to sell price always at the top of the price. No investor in the world, I can tell you consistently. Yes, it can happen once or twice that you are lucky, not because of your intelligence, just because you are luck. So the moment you realize the fact, and then if you make yourself convinced, hey, I will not be able to sell at the top of the price, that fear will go up. That what if I get out of the company and the script goes up, that fear will go up. And the reason you don't sell, and ask yourself, does it not apply to you? You will also admit, yes, it does happen to me. So what if the company moves up after I sell? That fear is the reason why you don't get out of the company. That's why your strategy is poor. You are making good money, but that fear is holding you back. And that's why you don't get out of it. Reason number 3, you don't have a stomach to book losses. Normally, your exit strategy is a poor exit strategy because the script has gone down below your purchase price and you don't have a stomach. Then you live in an eternal hope that yes, one fine day this company will go above my purchase price. That's a reason number 3. Reason number 4, when your purchase price is too low, and hence you don't have an urgency to sell. So I had very recently, I think that happened when I was talking about Mohit and me were on one of the webinar, and I was talking to some gentleman who was from Canada, and I was telling him that Canadian real estate market is going to be looking a little frothy in terms of its valuations. And he said, "Because my purchase price is very low." He seems to be from Canada. He must have bought that property from Canada. And that's a wrong thing. Yes, the purchase price is low doesn't mean that you should not book profit. It doesn't make a sense that the purchase price is maybe 10 rupees, the script goes to 1,000 rupees, and you will continue to hold till the script comes down to 500 rupees. Because you lost that 500 rupees, isn't it? So that's another reason. That's a fallacy that people basically believe that since my purchase price is low, I should not be in an urgency to sell. That's a wrong thing. If you know that company is going to fall, underperform, please get out of that company. What's on the earth? Basically, you don't want to book profit. Should you not have a strategy to maximize your profit? And if yes, then your purchase price, where does it become an anchor for you to decide whether you make an exit or not? At MarketsMojo, I must tell you, we don't make purchase price as an anchor price to decide whether you should get out or not. Okay. Reason number 5, when you have seen that companies going up and that higher purchase price, that 52-week high or all-time high, become anchored in your mind. It's a psychological issue. And hence you don't want to get out of that, because you will now say, that's another logic that works. That's human behavioral finance issue. Reason number 6, lethargic attitude, despite known facts. And I'll tell you my own example. There's a company called Suraj Diamond. And this company, I don't know, many of you may not be aware, but this company, the fraud came out that they basically did the defrauded bank. They did fraud with the bank to the tune of 6,500 or 7,000, but I'm not able to recollect that amount. And I was owning Suraj Diamond. I know the promoter very well, Mr. Jatin Mehta. And I thought, nahi nikalnega. And of course, I was holding very few dead shares or so and so forth. I did not get out of that company. I continue to hold that company today, despite I knew that this company may problem hai. Like DHFL, you may not have got out of it. The company like Vakrangi, there's another company called Asapura Intimate. I don't know how many people are aware. Now it was very obvious because the company may problem hai. If problem nikal jao na, but sometimes we are little lethargic. We don't want to get out of that company, or sometimes we basically believe that ये sahi nahi hai. And that's why I'm also accepting. I also have that kind of an attitude. I'm also human being, so of course I do fall. But this is what we need to learn from this. And I realized the moment there is this one, I will get out. Lethargic attitude nahi. Okay, and that's why you don't exit. So reason is obvious, but you don't want to get out of that. Now it's in your interest that you should have a exit strategy and then follow that exit strategy in a very disciplined manner. And if you do that, let me tell you very frankly, you will create wealth for yourself and for your family members. You will live the life that makes you a very rich and happy life for you. So this is what the pointers I'm suggesting you. And if you can't follow that this strategy, let me tell you, assure you, MarketsMojo has a strategy in place to define exit. MarketsMojo as a platform which has an entry strategy, and we have a clearly defined exit strategy without any human emotion. And due to that, MarketsMojo has created a lot of wealth for the investors in last 5 years. The reason is very simple. We have an entry strategy, we have an exit strategy. And if you cannot follow what I suggested you, 16 plus 3 plus 7, please become a MarketsMojo subscriber and start following our advice. So thanks a lot, everyone, for taking time out and attending this webinar. Thanks a lot, Jason.